Question 1. Which of the following is a characteristic of a fixed annuity? A. The annuity value is linked to stock market performance. B. The payments to the annuitant may fluctuate based on the performance of a specified index. C. The annuity provides a guaranteed minimum interest rate. D. The annuity requires the annuitant to choose an investment option from a selection of sub-accounts. Answer. C. Explanation. Fixed annuities are designed to provide the annuitant with guaranteed periodic payments or a guaranteed interest rate during the accumulation phase. The annuity value is not subject to market fluctuations, unlike variable or indexed annuities. Option C is correct because fixed annuities provide a guaranteed minimum interest rate. Option A is wrong because fixed annuities do not link their value to stock market performance, which is characteristic of variable annuities. Option B describes indexed annuities, not fixed annuities. Option D is a feature of variable annuities, not fixed annuities. Question 2. Scenario-based question. Mr. Harris, a 65-year-old retiree, is looking for an annuity that will provide a guaranteed income for the rest of his life, ensuring that his spouse will also receive income after his death. Which of the following annuity options is most suitable for Mr. Harris? A. Single life annuity. B. Joint and survivor annuity. C. Immediate annuity. D. Fixed indexed annuity. Answer. B. Explanation. Mr. Harris needs an annuity that will provide income for both his lifetime and his spouse's lifetime. A joint and survivor annuity, option B, is the most suitable option because it guarantees payments to both the annuitant and a designated survivor, such as his spouse, after the annuitant's death. Optionals or single life annuity would only provide payments during the annuitant's lifetime, so it does not meet Mr. Harris's need for a survivor benefit. Option C, immediate annuity, would start payments immediately but doesn't necessarily provide survivor benefits. Option D, fixed indexed annuity, may offer growth potential linked to an index but doesn't automatically guarantee lifetime income for both parties, which is critical in this scenario. Question 3. Which of the following is true regarding the tax treatment of distributions from a non-qualified annuity? A. Distributions from a non-qualified annuity are taxed as capital gains. B. Non-qualified annuity distributions are subject to ordinary income tax on the entire amount. C. The principal portion of the distribution from the non-qualified annuity is tax-free. D. Non-qualified annuity distributions are exempt from taxes if taken after the age of 591. Answer. B. Explanation. Distributions from a non-qualified annuity are subject to ordinary income tax on the earnings portion or the principal portion. The amount invested is not taxed again. This means that the earnings, not the principal, are taxable when distributions are made. Option B is correct because non-qualified annuity distributions are taxed based on the growth interest as ordinary income. Option is incorrect because annuity distributions are taxed as ordinary income, not as capital gains. Option C is incorrect because the principal portion of a non-qualified annuity is not subject to tax, but only the earnings are. Option D is incorrect because the age of 591 does not provide a tax exemption. Early withdrawal penalties may apply for distributions taken before age 591 unless exceptions are met. Question 4. Which of the following is a characteristic of a variable annuity? A. The investment options are guaranteed to return a fixed interest rate. B. The value of the annuity depends on the performance of the chosen sub-accounts. C. It provides fixed income payments for the lifetime of the annuitant. D. The annuity's growth is based on a specified index rather than market performance. Answer. B. Explanation. Variable annuities allow the annuitant to choose from various sub-accounts, typically invested in mutual funds, with the annuity's value depending on the performance of these sub-accounts. Option B is correct because the performance of the sub-accounts determines the value and growth of a variable annuity. Option A is incorrect because variable annuities do not guarantee a fixed interest rate. The returns can fluctuate based on market performance. Option C describes a feature of fixed or immediate annuities, not variable annuities. Option D describes indexed annuities, not variable annuities. Question 5. Which of the following statements best describes the accumulation phase of an annuity? A. The phase when annuity payments begin to be paid out to the annuitant. B. The phase when premiums are paid into the annuity and the value of the annuity grows. C. The phase when taxes on the annuity's earnings are levied. D. The phase when the annuitant decides how the annuity will be distributed. Answer. B. Explanation. The accumulation phase is when the annuitant makes premium payments into the annuity and the annuity's value grows, often on a tax-deferred basis. Option B is correct. Option A describes the distribution phase, which occurs after the accumulation phase, when annuity payments begin. Option C is incorrect because taxes are generally deferred during the accumulation phase. Option D is incorrect because distribution decisions are made during the distribution phase, not the accumulation phase. Question 6. Scenario-based question. Mrs. Thompson, a 72-year-old, purchased an annuity with a lump sum payment. The annuity is structured to provide monthly income payments for the rest of her life. However, Mrs. Thompson is concerned about the possibility of dying before she receives the total amount of her premium back. Which settlement option should Mrs. Thompson consider to address her concern? A. Life-only option. B. Life with period certain option. C. Joint and survivor option. D. Fixed period option. Answer B. Explanation. The life with period certain option ensures that the annuitant, Mrs. Thompson, will receive monthly payments for her lifetime, and if she passes away before receiving payments for the specified period, e.g. 10 or 20 years, her beneficiary will continue to receive the payments for the remaining period. This option addresses Mrs. Thompson's concern about dying before receiving the full premium amount. Option Life only does not provide any guarantees beyond the annuitant's life, leaving the beneficiary with no payments if the annuitant dies early. Option C, Joint and Survivor, is designed for couples, not for individual retirees. Option D, Fixed Period, offers payments for a set period but not for the annuitant's lifetime. Question 7. Which of the following would most likely trigger a surrender charge on an annuity? A. Taking a distribution after the annuity has been in force for more than 10 years. B. Withdrawing more than the allowed free withdrawal amount during the early years of the contract. C. Electing a lifetime income option as the distribution method. D. Choosing to add a death benefit rider to the annuity. Answer B. Explanation. A surrender charge is typically applied when an annuitant withdraws more than the free withdrawal amount, often 10% per year during the early years of the contract. Option B is correct because these charges are most often levied in the first several years of the annuity contract when withdrawals exceed the allowable limit. Option is incorrect because surrender charges generally apply in the early years, not after 10 years. Option C describes an income option, which does not typically incur surrender charges. Option D relates to adding a rider, but it does not directly cause a surrender charge. Question 8. What is the impact of a 1035 exchange on the tax treatment of an annuity? A. The exchange results in the immediate taxation of the earnings. B. A 1035 exchange allows the transfer of the annuity's value without triggering tax consequences. C. The exchange is taxable, but the tax is deferred until the annuity is surrendered. D. The 1035 exchange reduces the annuity's tax-deferred growth potential. Answer B. Explanation. A 1035 exchange allows an annuity owner to exchange one annuity for another without triggering tax consequences on the earnings. The tax deferral remains intact and the transfer of the value from one policy to another is not taxed at the time of exchange. Option B is correct. Option A is incorrect because a 1035 exchange defers taxes, it does not trigger them immediately. Option C is incorrect because the exchange itself is not taxable, so there is no immediate tax due. Option D is incorrect because a 1035 exchange preserves the tax-deferred status of the annuity. Question 9. Which of the following best defines a deferred annuity? A. An annuity where the payout begins immediately after purchase. B. An annuity that provides payouts after a delay, typically several years. C. An annuity that is not subject to market risk. D. An annuity that only offers a fixed interest rate during the accumulation phase. Correct answer B. Explanation. A deferred annuity is structured to begin making payouts at a future date, typically several years after the purchase. Option B is correct because it accurately describes a deferred annuity. Option A describes an immediate annuity, not a deferred annuity. Option C is incorrect because deferred annuities can be either fixed, variable, or indexed, and some may be subject to market risk, e.g. variable annuities. Option D incorrectly limits deferred annuities to only offering a fixed interest rate, which is not true, as they may also offer variable or indexed options. Question 10. Which of the following is a common feature of a living benefits rider attached to an annuity? A. It guarantees income payments for a specific number of years. B. It allows the annuitant to access funds for long-term care expenses. C. It ensures that the annuity's value will not decrease in any market condition. D. It increases the death benefit of the annuity. Answer: B. Explanation. A living benefits rider often allows the annuitant to access their annuity's funds for certain purposes, including long-term care expenses, without incurring penalties. Option B is correct because living benefits often address specific needs such as long-term care. Option A refers to a type of settlement option but does not define living benefits. Option C is incorrect because living benefits do not guarantee market performance, so they provide specific benefits related to the annuitant's health or care needs. Option D refers to death benefit riders, not living benefits. Question 11. Which of the following is a primary characteristic of fixed annuity? A. The annuity's value fluctuates based on the performance of underlying investments. B. The annuity guarantees a fixed rate of return for a specified period. C. The annuity's value is tied to a stock market index. D. The annuity has no surrender charges. Answer: B. Explanation. A fixed annuity guarantees a fixed rate of return for a specified period, providing a predictable stream of income. Option B is correct. Option A refers to variable annuities, not fixed annuities. Option C refers to indexed annuities, not fixed annuities. Option D is incorrect because many fixed annuities still have surrender charges during the early years. Question 12. What is the main advantage of purchasing an annuity as part of a retirement plan? A. The annuity guarantees that the principal will always be preserved. B. The annuity's earnings grow on a tax-deferred basis until withdrawn. C. The annuity pays out a lump sum at the beginning of retirement. D. The annuity allows the annuitant to invest in a wide range of stocks and bonds. Answer: B. Explanation. One of the key advantages of an annuity, particularly in a retirement plan, is the tax deferral on earnings until the annuitant begins withdrawals. Option B is correct. Option A is incorrect because fixed annuities guarantee principal but not necessarily the growth. Option C is incorrect because annuities often provide periodic payouts, not a lump sum. Option D refers to variable annuities that provide investment choices, but not all annuities do. Question 13. Which of the following is true about a guaranteed minimum income benefit (GMIB) rider on an annuity? A. It guarantees a minimum income level regardless of market performance. B. It provides an additional death benefit to the annuity's beneficiary. C. It allows the annuitant to access their funds at any time without penalty. D. It increases the annuity's cash value based on stock market returns. Answer: explanation. A GMIB rider guarantees that the annuitant will receive a minimum level of income even if the underlying investments perform poorly. Option A is correct. Option B describes a death benefit rider, not a GMIB. Option C is incorrect because GMIB does not waive surrender charges or penalties for accessing funds early. Option D is incorrect because the GMIB guarantees a minimum income, not cash value growth tied to stock market performance. Question 14. Which type of annuity is most likely to be affected by changes in the stock market? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Fixed period annuity. Answer: C. Explanation. A variable annuity's value and payouts are directly tied to the performance of the underlying investments, which can include stocks and bonds. Option C is correct. Option A refers to fixed annuities, which are not impacted by the stock market. Option B refers to immediate annuities, which typically provide fixed, predictable payments. Option D refers to annuities with fixed payout periods, which are also generally not affected by the stock market. Question 15. Which of the following is a potential disadvantage of purchasing an annuity? A. Annuities always offer higher returns than traditional investments. B. Annuities often come with surrender charges if funds are withdrawn early. C. Annuities are not eligible for tax deferral. D. Annuities offer no protection against inflation. Answer: B. Explanation. Annuities often come with surrender charges, which are fees for withdrawing funds before the end of a specified period. Option B is correct. Option A is incorrect because annuities may not always offer higher returns compared to other investments. Option C is incorrect because annuities do offer tax deferral on earnings. Option D is not entirely accurate because some annuities, such as inflation-adjusted annuities, are designed to protect against inflation. Question 16. What is the primary purpose of a death benefit rider on an annuity? A. To ensure the annuitant receives a guaranteed income for life. B. To provide a lump sum to the beneficiary if the annuitant dies before payments begin. C. To increase the annuity's value based on investment performance. D. To allow the annuitant to access additional funds for long-term care. Answer B. Explanation. A death benefit rider ensures that if the annuitant dies before receiving payments, the beneficiary will receive the premium or a set amount, typically the account's value. Option B is correct. Option A describes a lifetime income rider, not a death benefit. Option C refers to the investment performance, but not to the death benefit rider. Option D is a description of a living benefits rider. Question 17. Which type of annuity offers payouts for a fixed period rather than for the annuitant's lifetime? A. Immediate annuity. B. Fixed period annuity. C. Fixed annuity. D. Variable annuity. Answer B. Explanation. A fixed period annuity pays out a set amount of income for a specified period, e.g. 10-20 years, not for the annuitant's lifetime. Option B is correct. Option A refers to immediate annuities, which begin paying right away, but not necessarily for a fixed period. Option C refers to fixed annuities, which provide predictable income, but not based on a fixed period. Option D refers to variable annuities, which provide income that may fluctuate based on investment performance. Question 18, scenario-based question. Mr. Jones is considering an annuity but is concerned about the possibility of needing his money earlier than expected due to an emergency. He would like an annuity that allows him to take out some money without incurring a penalty. Which feature should he look for? A. Surrender charge. B. Free withdrawal provision. C. Death benefit rider. D. Inflation protection. Answer B. Explanation. The free withdrawal provision allows annuitants to take a specified amount, often 10% of the annuity's value, without incurring surrender charges. Option B is correct. Option A is incorrect because the surrender charge is what Mr. Jones wants to avoid. Option C describes a death benefit which does not address emergency withdrawals. Option D is incorrect because inflation protection addresses future purchasing power, not emergency access to funds. Question 19. Which of the following best describes the annuitization process? A. The process of withdrawing funds from an annuity in a lump sum. B. The process of converting the accumulated value of an annuity into a stream of income payments. C. The process of investing the annuity in stock or bond funds. D. The process of adding additional funds to an existing annuity. Answer B. Explanation. Annuitization is the process of converting the accumulated value of an annuity into periodic income payments, typically for the annuitant's lifetime or a fixed period. Option B is correct. Option A describes a lump sum distribution, not annuitization. Option C refers to the investment of the annuity's funds, which happens during the accumulation phase. Option D refers to making additional contributions to an annuity. Question 20. What is the primary benefit of purchasing a joint and survivor annuity? A. The annuity provides the highest level of income to the annuitant. B. It guarantees income payments for the lifetimes of both the annuitant and their spouse or partner. C. The annuity has a flexible payout period that can be adjusted based on the annuitant's needs. D. It provides a lump sum payment at the death of the annuitant. Answer B. Explanation. A joint and survivor annuity provides income for the lifetimes of both the annuitant and their spouse or partner. The payments continue until both individuals have passed away. Option B is correct. Option It describes an individual annuity, not the joint and survivor annuity. Option C is incorrect because joint and survivor annuities generally provide fixed payments. Option D refers to a lump sum death benefit, which is not characteristic of joint and survivor annuities. Question 21. Which of the following best describes the accumulation phase of an annuity? A. The period during which the annuitant receives income payments. B. The period during which the annuitant contributes funds and the value of the annuity grows. C. The period during which the annuity value is fixed and guaranteed. D. The period when the annuity starts paying a death benefit to the beneficiary. Answer B. Explanation. The accumulation phase is the time during which the annuitant deposits funds and the value of the annuity grows either through interest or investment performance. Option B is correct. Option It describes the payout phase, not the accumulation phase. Option C refers to the period during which a fixed annuity guarantees a fixed income, not the accumulation phase. Option D is incorrect because death benefits apply to different riders, not the accumulation phase. Question 22. Which type of annuity provides the highest potential for growth but also carries the greatest risk? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Fixed period annuity. Answer B. Explanation. Variable annuities offer the highest potential for growth as their value depends on the performance of investments chosen by the annuitant, such as stocks or mutual funds. However, they also carry the greatest risk because the value can fluctuate based on market performance. Option B is correct. Option A describes fixed annuities, which offer stable but low growth. Options C and D do not provide variable investment options. Question 23. Which of the following is not a common feature of most annuities? A. Guaranteed death benefit. B. Tax deferral on earnings. C. Guaranteed income for life. D. Flexibility to withdraw funds at any time without penalties. Answer D. Explanation. Most annuities have surrender charges or restrictions on withdrawals, meaning funds cannot always be accessed without penalties. Option D is correct because it is not a common feature. Options A, B, and C are common features of annuities. A death benefit may be available through a rider, earnings are generally tax deferred, and many annuities provide guaranteed income for life. Question 24. Which of the following statements is true about a living benefit rider on an annuity? A. It guarantees that the annuitant will receive at least their original investment back. B. It provides an additional benefit if the annuitant becomes disabled. C. It ensures that the annuitant will receive a set income for life even if the account value falls to zero. D. It guarantees a return based on the performance of the stock market. Answer C. Explanation. A living benefit rider guarantees that the annuitant will receive a set income for life even if the annuity's value falls to zero. Option C is correct. Option It describes a different feature typically associated with a death benefit rider, not a living benefit. Option B refers to a disability rider, not a living benefit rider. Option D is incorrect because a living benefit rider does not guarantee returns based on the stock market. Question 25. Which of the following is a key advantage of a longevity rider on an annuity? A. It increases the annuitant's income payments as they age. B. It allows the annuitant to invest the annuity's funds in stocks or bonds. C. It provides a lump sum to the annuitant at the end of the contract. D. Ensures that the annuity will provide income for a fixed period only. Answer A. Explanation. A longevity rider increases income payments as the annuitant ages, providing extra income later in life when it may be needed the most. Option A is correct. Option B refers to the variable investment options in some annuities, but is not related to a longevity rider. Option C describes a lump sum option, which is not a feature of a longevity rider. Option D describes a fixed period annuity, not a longevity rider. Question 26. Which of the following is true about the death benefit of an annuity? A. It is always equal to the value of the annuity at the time of the annuitant's death. B. It is typically paid to the beneficiary as a lump sum, regardless of the annuity's current value. C. It guarantees that the beneficiary will receive at least the original amount invested. D. It provides ongoing income payments to the beneficiary for the beneficiary's lifetime. Answer C. Explanation. A death benefit typically guarantees that the beneficiary will receive at least the original amount invested even if the annuity's value has decreased. Option C is correct. Option A is incorrect because the death benefit may not always be equal to the current value if there are withdrawals or losses. Option B is not correct because death benefits can sometimes be paid as a lump sum but are not always guaranteed regardless of the annuity's current value. Option D refers to income annuities, not death benefits. Question 27. Scenario-based question, MS. Garcia purchases an annuity with a 10-year period certain payout option. Which of the following is most likely to happen if she passes away before receiving all of the guaranteed payments? A. The remaining payments will continue to her beneficiary. B. The annuity will end immediately and no further payments will be made. C. The payments will be doubled to her beneficiary. D. The payments will convert to a lump sum. Answer A. Explanation. If an annuity has a 10-year period certain payout option, the annuity continues to pay out for the entire 10-year period even if the annuitant dies before receiving all payments. The remaining payments will go to the beneficiary. Option is correct. Option B is incorrect because the 10-year period certain guarantees payments for 10 years. Options C and D are incorrect because neither doubling the payments nor converting to lump sum applies in this situation. Question 28. Which of the following is an example of a spousal continuation feature in an annuity? A. The annuity's payments continue to the spouse if the annuitant dies. B. The annuity allows the spouse to choose a lump sum payout. C. The spouse can adjust the annuity's investment options at any time. D. The spouse is exempt from surrender charges if they take early withdrawals. Answer A. Explanation. A spousal continuation feature allows the annuity to continue paying out to the spouse if the annuitant dies. Option A is correct. Option B refers to lump sum payout options but is not specific to spousal continuation. Option C describes a feature more related to variable annuities. Option D refers to surrender charges, not a specific spousal feature. Question 29. Which of the following statements is true about the income for life option in an annuity? A. It guarantees that the annuitant will receive income payments for a specific period, such as 10 or 20 years. B. It guarantees that the annuitant will receive income payments for as long as they live. C. It allows the annuitant to withdraw all of their funds at any time. D. It increases income payments if the annuitant's account value decreases. Answer B. Explanation. The income for life option guarantees that the annuitant will receive income payments for as long as they live, regardless of how long they live. Option B is correct. Option A describes a fixed period payout option, not income for life. Option C is incorrect because annuities typically limit withdrawals. Option D refers to the potential for increased income through other features, not the income for life option. Question 30. What does the step-up feature in an annuity allow? A. It allows the annuity's payments to be increased based on inflation. B. It allows the annuity's value to be increased based on market performance. C. It increases the death benefit over time. D. It guarantees higher income payments after a set period. Answer C. Explanation. The step-up feature in an annuity typically refers to increasing the death benefit over time. This feature allows the beneficiary to receive a higher death benefit based on the annuity's performance or other factors. Option C is correct. Option A refers to inflation-adjusted annuities, not the step-up feature. Option B is a general description of investment-linked annuities, but not step-up features. Option D is a misunderstanding of the step-up feature's function.